Welcome into Phil's Tax Hacks and Other Retirement Facts with CPA and personal financial specialist, Phil Putney. Now let's get rolling with today's show. Hey everybody, we're back here on Phil's Tax Hacks and Other Retirement Facts for the second half of the prior podcast when we were talking about important financial debates, conversations. Where do people stand? Where does Phil stand? You know, all that good kind of stuff. We were doing kind of a top 10 countdown.
Top 10, yeah.
Yeah. We broke it into two. So we did the first five. Now we're going to do the second five. And of course, Phil, we're into the middle of June now. So, hey, it's fully
it's
hot.
getting warm. That's right. That's right. A little hotter your way, but it's getting warm.
Yeah, that's okay. I hope everybody's having a good, summer's rolling.
Good summer, yeah.
It's always funny. It's like summer's not till the end of June officially.
I know, that's always cracked me up. So especially because it seems like, at least in Michigan, the seasons have moved where, summer happens earlier and it ends earlier. It's just weird. So
it's almost like retirement age, right?
That's right.
We're living longer, but the numbers don't change, right?
That's right. There you go. Hey, nice segue. I like that.
You like that? Yeah. But seasons do seem to be like that, right? It's you think, man, is it, then again, then you stop thinking about it. You think, has it always been that way? Why did we?
Yeah, it's just because we always have this recency bias, right? We're always thinking just in the last 5 years. But if you look back, has it always been that way? It's just feels that way now, or
I think they picked those. You can let us know, folks, if we're wrong. I think they picked those based on like the older lunar calendar and summer solstice and all that kind. And I definitely think that stuff has shifted a little bit.
Things have shifted. Yeah,
it feels like to me, like even when I used to live in Indiana, which Midwest versus in the South, it was always hot in June too. So
yeah,
feels like summer should have really been more like Memorial Day. I don't know why we just didn't make it Memorial Day, but anyway, I digress.
Like many things that just make way too much sense. So why would we do that? It's
like the 59.5 and that old 70.
That's exactly.
Why does this just make things easy? I remember we're getting all crazy here, folks. But I remember growing up in Indiana, as I mentioned, we used to where we live, the time change didn't exist.
Okay. You were the fortunate ones, yeah.
Yeah, where you never changed daylight savings time.
Daylight savings, and
it was like, this is just easy. Like, why do we not, And I know
throws your body off. It takes forever to get back on. It's just, that's a mess.
And I know Congress has floated the idea of eliminating that and making it making daylight savings time the permanent time.
Yeah.
Yeah. A little kid standing outside in pitch black are like, no.
What are we doing?
Waiting for the school bus. They're not happy about that idea. All right. Anyway, let's jump back in, folks, to the other parts, the other five here that we have on the conversation. So, we went through, paying off the house, and we went through bonds. We went through insurance needs, annuities, fee-based versus broker-based. And of course, if you did not check that out, just go check out the past episode. You don't have to listen to that to listen to this one, but you get the other five. Definitely consider going and doing that as well. So let's go into number 6 here, and that will be the lower tax bracket conversation, Phil. We're in a lower tax bracket once we get to retirement age. So it's best to defer those taxes. This is the traditionalism, right?
Yep.
And just pay them later on. This is what we've been taught. This is what we've done for 50 years.
Yes. Yeah. And I think for those that are probably listening to this podcast, those that have saved for retirement planned, have accumulated some assets, they might even have a pension, they might have had a higher income, so they've got higher Social Security. For that individual, I don't think that's reality. In fact, I can just say from experience, let's put it this way.
Okay. All right.
I would say for sure 80%, it might even be higher than that,
are not.
Of the clients that I work with are not
in a lower tax bracket when they retire. Once you count, okay, we've done some planning and we've figured out the right strategy for Social Security. Let's say they might even have a pension and they've saved. So once you build up all those together and you figure, okay, here's those income streams. Now we add in a required distribution. Oftentimes that combined income is equal, maybe even greater than what they were when they were working, which is a great thing. From a retirement standpoint, that's awesome. Right. From a tax standpoint, that's terrible. Yeah, and as a CPA, right? You're looking at through that lens, and as well as a personal financial specialist. But again, we've been taught this to our age, Phil, as well as the age of a lot of your clients. This is what we've been told for 40 years. Yet it's just really not. Well, you said 80%.
not the
right.
case.
I mean, at least the experience of the clients I work with. Now there are occasions, and few
there are
of them
occasions,
are,
but it's that rule of thumb that doesn't stick.
Right. Again, you can't use the rule of thumb. And I mean, it's funny you mentioned CPAs because, and I'll go back to my own personal experience. I mean, I'm a CPA, I'm a financial advisor. I started as a CPA, and I can tell you back when I was just a CPA and well into being a financial advisor and a CPA, I never believed in this whole concept of planning and, Roth conversions and all that thing. Yeah. Why, first of all, you can't think down the road that long. I mean, CPAs generally, I always say they got the blinders on, right? The world they live in is last year, this year, and next. That's the only things they're always looking at.
Like the horses in the horse race.
Right. I mean, that's just what they do all the time. And how do you judge if your CPA did a good job this year? Well, I had to pay taxes. That's terrible, Yeah. So how do they help prevent that? Well, you put more in the 401k. I mean, they're always looking at this year. They're not looking at, well, when you retire 10, 15, 20 years down the road, what does that look like? It's just not how they're trained and what they do. So nothing against CPAs. I get it. I was there. It's just the world that they were in and how their focus was, right?
Yeah.
My focus, I'm still a CPA, but my focus has now been changed where I'm looking at a broad focus. I'm not looking at just today. In fact, a lot of times the clients I'm working with are paying a lot of taxes right now, way more than what they even paid in retirement because we're doing conversions, we're repositioning assets because we're trying to prepare and plan for longer term in retirement.
Oh yeah. So
it's perspective.
Yeah.
Right. So it comes down to, you mentioned rules of thumb, you got to have perspective is the first thing. For taxes, never look at today because you're going to get the wrong answer. You're going to get the answer for today. But if you want the long-term picture on taxes, you've got to look at a bigger perspective and how does it affect you long-term versus where is it at today?
I wonder if this type of rule of thumb, this type of lower tax bracket conversation was also salary-based. Maybe once upon a time it was like you fell into because obviously wages have gone up a lot in the last 30 years, let's say, so I wonder if that
I think it's that. I think it's, mortgages, it used to be. So, back in the day, right? How many times did you buy and sell a house? Not many,
right?
You stayed in a house forever and the mortgage was paid off. It wasn't even a discussion.
Yeah.
Well, how many times do you buy and sell a house today?
Yeah.
What, 5 years? That's kind of average. People stay in a house, they're always moving.
And for our demographic that you mentioned, how much did you pay? So you and I are close to the same age, but somebody who's 70, they think about the price of a brand new truck and the price of their first house.
Exactly. Yeah. And today the new truck is about the same as that first. Yeah. But
that truck 35 years ago was, when you see stories like that, it's like we're both car guys, and it's like, oh man, could you imagine buying a C10, 1960 or 1969 C10 or something like that, for $4,200 brand new, whatever. And now it's, $70,000 for a brand new truck, fully loaded.
Yeah. Yeah, it's crazy. It's all about perspective. So
yeah. And the same thing with the tax brackets, right? So
right. Yeah, you have to look at it the perspective. Yeah.
I wasn't expecting you to say that. That's pretty.
Yeah, it's and again, I work typically with those that have done well saving, right?
Sure. Yeah.
But they're trying to figure out all these pieces, and the tax is the one piece that they've really never thought of. They've always been down this road, running, saving as much as they can in the 401k. Deferring and done the same thing forever, which is great. They're in a very good financial position, but
exactly.
The tax scenario there's a lot of room for planning and opportunity.
Well, we did what we were taught.
Right.
And if you did that, fantastic. But yeah, now you got to pay the piper, which Uncle Sam's been waiting. And that's where some now tax efficiencies and strategies come into play, which, again, working with someone like yourself can be beneficial.
Well, and I hear all the time when I'm working with these clients, it's like, somebody should have told me this before. I wish I would have known. I would have changed how I was doing things, So if we have younger viewers on this, listening in, hey, don't get caught in that trap.
Yeah.
Learn from the generation that preceded you and here's some of them. Yeah. Which exactly
crazy talk.
Listen to your parents.
Crazy talk.
Crazy talk. But sometimes your parents are right. I think you realize that once you start having kids.
I know, right? It's like, even if you don't want to, if you're one of those people that's like, I'm never going to admit my parents were right. If for no other, just because of your parents, if for no other reason, it's just because they've lived life a little longer.
Right. A little bit of experience. Yeah. Perspective.
We now have the shoulda, coulda, woulda. So we're telling you before you get the shoulda, coulda, woulda.
Yep.
Exactly. I tell my daughter that all the time, and she's like, "Yeah, Dad." I'm like,
"Yeah, whatever, Dad.
I'm doing fine now." And I'm like, "Yeah, you're doing fine, but you could be doing better later.
You could do so much better." Yeah,
just a little bit too.
A little change.
Love you, dear. All right. So let's go to number 7 here, Phil, on the total list. You should never use credit cards. Now, I'm waiting to see I'm curious about this as a CPA and as a financial specialist. Credit cards, they're not really our friend, but do they have uses?
I only use credit cards. I mean, I love them.
Well, there you go.
And there's pros and cons, right?
How do you use it?
The reason I use it and love it is, number one, I don't have to worry about, carrying cash around and dealing with it. From a protection standpoint, it's easy, especially if you buy things online, because, if your credit card gets compromised and somebody charges something on it, hey, just call a credit card company and say, I don't recognize this charge. And they'll dispute it and figure it out, right? You don't have to worry about it. Where if it was a debit card, well, that money's out of your bank. And then, tell your bank that, well, then they're going to fight with it. And it might be a month before you get the money back.
And then you don't have the debit card and they got to reissue it.
Yeah. So it's a whole nightmare. So
Phil, you're talking about a tool and how you use it.
Right. And I love it because it's very traceable, right? I mean, I don't know exactly at the end of the month, here's where everything went, and I use cards that give me points. I mean, we get a lot of points. I love it,
Miles, yeah.
But the whole key is I pay it off every month.
And that is knowing yourself. That is the key. And that's knowing you.
Yes.
You've got to be comfortable with yourself because you know who you are. If you know that credit cards are a bad temptation for you, then maybe never using a credit card is a good strategy for you. But to your point, I think based on those things you illustrated, it is another really useful tool.
Yes.
And the credit card company, they're playing this game a little bit. Like if you're smart like that, like you're doing, okay, fine. They're not really going to make a lot off of Phil. But if the person
they don't make anything off of me, I never pay them interest.
Right.
So
if the person
I'm their worst nightmare.
And they're playing that same game that insurance companies play. They're basing the statistics, the numbers.
Yes.
There's a lot more X person who spends and doesn't pay it and runs up a huge debt than there are Phils.
Yes. Yeah. I mean, it's exactly. So and this is something I even deal with my own kids and walking them through this experience, because they're always talking about, well, this credit card does this and this, all these benefits. And that's great, but it's got to get paid off. Just make sure you pay it off. So whatever that works for you. I mean, if
maybe the beauty of American Express, right?
Right. If it's as simple as, you make a payment every single week at the end of the week, you pay off from your bank what was charged that week. So it's gone. I mean, it's no different than a debit card then, but now you're getting the benefits, whatever it takes for you to make sure that happens, just do it. Yeah. But to your point, at the end of the day, credit card companies are making money at this. They couldn't afford to give me 2% back on everything, and not make it not work.
They're making a lot profitable. Somebody. Yeah.
I always joke with, it's about, casinos. You walk into a casino, look at the casino, just stop and look around and you tell me who's winning. I don't care what you think in your experience.
Gorgeous and immaculate.
Who's winning this game? The casino.
Yeah.
I mean, they're hands down. I mean, they can build the facilities they have and staff it with what they have for nothing, right? So they're winning more than they're losing. So it's a tool.
Numbers game.
It's a numbers game. It right.
Yeah. Playing in percentages and it's a numbers game. But I think that's interesting though. Like if folks, if you're listening to this and you're watching this, you've got a financial advisor saying, I love credit cards, right? There's the headline, right? Yep. So all of a sudden in today's world, you take that and you go, financial advisor says, I love credit cards. And then 200 people go, well, because this financial advisor said it, I love credit cards too, and so just like anything, take it for what it is for you. Take the information and say, okay, if I can do the same kind of things that Phil's talking about, then it maybe is a useful tool for me.
Mm-hmm.
But if I know that I'm a spend happy fool if I get this thing on me, then let's not do that, right? So,
or make sure your limit's at a level where you can't get yourself in trouble or whatever it is. I mean, it's
that's what I do. I have
understand the pros and cons and how it works, and put limitations if you need it, so you better understand how this works and you don't get yourself in trouble.
That's right. So a lot of us do a lot of streaming things or recurring charges.
Yes.
I have a little credit card that has a pretty low limit, and that's all I use it for. Is, to your point, Phil, is the online purchases and the little streaming reoccurring charges or whatever, so that it all goes to one spot, and I know exactly what's going on, and it's easy to drop, replace, whatever the case is, and it can't get me in too much trouble because I keep the limit low.
Lower limit. And yeah. That is one of the downsides to credit cards, though, is you have to look through that bill, because to your point, with there all these different everything's today is a service, right? It's a monthly fee. It's not a one-time buy, so just watch what's going on, because it's like, oh, I forgot I got that. I don't use that anymore. I need to get rid of this and this. Yeah.
Yeah, I think we did an episode a while back on that, like on how to go through and look for some of that stuff, because you've got like, when did I have 12 services that I don't use?
Yep.
I know there's apps out there that'll do that for you too, but just, be careful with that.
Mm-hmm.
Okay. Where are we at? Number eight. It's better to buy mutual funds or ETFs instead of individual stocks.
Okay. So similar to the discussion we had last time with bonds, right? So pros and cons. Individual stocks, let's start there. The advantage to that is, you're buying a company. So if you love whatever the company is, Apple, it's, everyone loves Apple, right? So if it's Apple, So, if it's that, whatever that company is, and that's what you want, then you have to buy the stock. The downside to it is a couple of things. Number one, limited exposure, right? If it does really good, you do really good. If it does really bad, you do really bad.
Right.
And the thing to remember with stocks is the stock value and the real value of the company have nothing to do with each other. Generally, they're not directly tied, right? Because you can have a company that is really sound financially and things are going good, but they're out of favor and their stock value doesn't represent that. Very often there's disconnects.
That's a monopoly term. I learned that in Monopoly, folks. They're out of favor. Your stock is out of favor, right?
In our neck of the woods, Ford is a great example. When we went back through 2008 and the financial crisis back then, they were a strong financial company. They didn't declare bankruptcy, all these other things, but their stock got hammered, and it's been way out of favor for years, but they've been, from a financial standpoint, a strong company.
Yeah.
So it's one of those, there's just a disconnect, right? The markets don't like them.
It's almost like a popularity contest sometimes.
It is. It's hilarious to me. It's but anyways, it's just understand that if you're looking at individual companies, that's where you want to go that direction, is I like X. I want to buy in that. The other downside to stock is you've got to just realize you can't buy fractions, right? So, Amazon, what's it trading at? 2,000 plus per share, or Berkshire. what is it? I forget what it is, so you can't buy fractional shares. So you have to have, depending on the size of the investment you're making, if you want a diversified portfolio, more than one stock. It sometimes becomes difficult if you're investing in individual stocks because the price is so high.
Now, is that where we can't, because fractional shares you can do though inside something like ETF or mutual fund or?
Well, yeah. So in an ETF or a mutual fund, you're not buying fractional shares of these individual companies. You're buying a pool of the investment. So ETFs,
right. I thought you could do some fractional stuff, but I guess not. Okay.
Well, in mutual funds and ETFs, you can.
Okay.
It's kind of goofy.
Yeah, I got
you. Those you can do fractional. ETFs you can't, because it's traded just like a stock. Mutual funds you can. It's just kind of weird.
Yeah. Okay.
But if you can get a broader exposure to many underlying companies inside an ETF or a mutual fund.
Right.
Because with a smaller investment.
Yeah. General rules with the mutual fund, because we've got the pool or whatever it is.
Right. So it just comes down to what you're trying to accomplish. If you love whatever XYZ company and you want to invest in that company, then buy that stock. Downsides, ups, and you're going to have a lot of volatility. You're going to get rewarded well if the company's in favor and lose if it's not.
But isn't that the same
exposure?
Right. But isn't that the same as a mutual fund? Like a lot of times, so if we have a mutual fund that's a whatever particular type it might be, which is I think where some people's disconnect in diversification comes into play, is they go, well, I've got 6 mutual funds, so I'm diversified because I don't want to be in an individual stock where it's high or it's low. I'm suffering, either way. I want to be in a mutual fund where I've got this pool of stuff because that way I'll stay diversified. Unfortunately, they tend to always be, not always, but they seem to be a lot of times large cap, for example. So if all large caps taking a beating, well, that doesn't matter if you're in a mutual fund because they're all taking a beating.
Well, yeah, so it depends. I mean, mutual fund, again, we're talking broad term, right? I mean, you can have a bond mutual fund, you can have a large cap, growth mutual fund.
Right, depending on the type.
You can have a balanced fund, which is both kind of built into that. So it depends on what kind of a fund you're in. But yeah, I mean, to your point is if you're in 6 different large cap growth mutual funds,
we tend to see the large caps though, I think.
You're not diversified.
No.
Right. Because if you look inside each one of those funds, they're going to all own the same thing, basically, so you don't have a lot of diversification there because underlying investments are about the same. So.
I'm glad you brought that up. That's a good point. Because yes, there's a lot of different mutual funds out there. I guess maybe I didn't do a good way of articulating that. When advisors tend to see people the first time for that evaluation, they tend to be in large caps only. They tend to be the same kind of thing. Yeah, there's a ton of mutual funds out there, but I think we don't do a good job or we're not told or whatever the case is in getting in them. For example, like a target date fund or whatever, we tend to be in the same things. And that's when you're going through your analysis process. You're like, hey, you got a lot of the same stuff.
Yeah. And to your point, just having X amount of mutual funds isn't going to give you diversification. It depends on what those funds are. You have to kind of look through the fund.
Okay.
To see the underlying investment, and just having 6 different mutual funds from different fund families, that doesn't give you diversification.
Or 6 different brokerage firms either, right?
Right. It comes down to understanding what's the underlying investment. In this case, we're talking the advantage to the mutual fund or the ETF is you get a broader exposure, right? Mm-hmm. Yeah. Hundreds of companies for a smaller investment, or even the same investment, but just a broader exposure.
Right.
Now you give up, there's a lot of pros and cons, right? The mutual fund, and I'm not a fan of mutual funds, and let me rephrase, retail mutual funds.
Okay.
Just because of the inflow and outflow all the time, right? And you don't, that manager
and there's fees
doesn't,
in that, right?
Well, there's fees built in you never see, right? And they don't have to disclose. It's funny that the expense ratio isn't the only fee. That's just what they have to tell you.
Yeah. Okay.
There's a lot of other fees built in that fund that you don't know are there. And the manager is always their hand is getting forced because of this inflow and outflow that happens all the time. So we're running through markets now, they're down, people are panicking, they're jumping out of mutual funds, and that manager is forced to sell some of the underlying investments to make a redemption.
Okay.
Because this advisor wanted out, or this investor wanted out, right?
Yeah. Yeah.
But if you're the investor that said, I understand markets and the ups and downs, I'm going to ride through it. Well, you're going to end up effectively inside that fund being forced to buy and sell shares at the wrong time because this investor wanted out. It's a pool, right?
Yeah.
Everyone's in the same pool. So when somebody does something in the pool, it affects everyone. So this person jumps out, that affects everyone in that pool, not just the person, that's invested long term. So
yeah, that's hilarious. That's a great way of looking at that. Yeah.
So that's where an ETF might be a better option because you don't have that effect in an ETF.
Okay.
But with ETFs, typically there's not the management as much. I mean, it's more of a fixed.
Yeah, pros and cons to everything, but I really appreciate sometimes getting a little further into it than the higher level stuff because we get inundated with so much higher level stuff and maybe that's all somebody can handle, but learning a bit more of the nuance to like that with the mutual fund that you just explained can go a long way for people to understand why maybe it's not the best fit for them. Because it's a traditional thing. Yep. Mutual funds, because I know that's the easy thing to do, and that's great.
And so one quick point on mutual funds too that is becoming real relevant. Now you're probably going to see it even more so this year, where 2020 it was down and then back up, so you didn't see a decrease in your value maybe of your fund.
Okay.
And you had capital gain distribution. So you might think, oh, that's okay. If this year, if we don't recover by the end of the year, let's say the market's still down, you're going to have some capital gain distribution. So you're going to have some taxable income, even though your value is down. And that's just structurally how that mutual fund works. That's one of the big downsides to it. And way more of a discussion than what we can get in on the podcast. And it's easier if I can draw it out. I do this in my class all the time. but it's something that I think people a lot of times get frustrated with. It's like, how in the world did I make all this money in this fund?
Well, you know what? Maybe I should
have gain distribution.
Maybe I should have you draw it all out, and we'll do a podcast just on that.
Yeah.
And then just pop up the visual aids there. All right. So yeah, good stuff down in the weeds for sure a little bit. But again, that's kind of the point of checking out podcasts and various different things. Sometimes, we try to keep it high level for broad viewers, but at the same time, sometimes people really want to get further into it. And of course, if you do have some questions about what Phil was talking about and getting further down into, that diagram or understanding some of the more of the things about the mutual funds, definitely reach out to him. Go by the website, philstaxhacks.com, and reach out to him that way. Let's knock out these final two here, Phil. Sure. We got number 9. You should start your Social Security as early as possible to get your money out of the system, because dang it, it's going broke.
Yeah, again, headlines, right? So we're always relying on headlines, and unfortunately, walking down that path, you're probably going to get the wrong decision. Now, let's address the issue right up front. Yeah, there's problems with Social Security, absolutely.
There's problems, yeah.
And there's things they need to do to fix it, but there's enough they can do to fix it that personally, I don't think those that are in their 60s, 62, even, let's say you're eligible right now, or beyond
55, but yeah,
I don't think you're going to see a structural change in your benefit, because there's enough they can do in how the system works, changing the benefits for everyone younger than that.
Yeah.
To really fix it, so don't make a harsh decision just because I've heard it's going broke. Because it's not going broke. What's happening is the trust fund is being spent down, which Social Security was designed as a pay-as-you-go system. Current workers paying in are funding the benefits being collected. It's always designed that way.
Yep.
Up until recently, though, we've had more workers paying in than collecting, so it's built the trust fund. So now we're starting to spend that down, but still like 75 to 80% of the benefits are coming from current workers paying in.
And of course, we've had worker issues, and we've had all these.
Yes, and there's exactly. There's been issues recently with it that exacerbated it, but understand the pros and cons, run the math. And then again, it's going to come down to comfort, but don't just go off a headline,
right?
Trust funds running out by 2030 or whatever it is, the late 35 or whatever the latest number is now. Yeah. Oh, I got to get it before it goes broke, because when you file for Social Security, you're locked in for life. So you could be making a wrong decision that has some long-term effects.
One little mulligan.
You get one mulligan. Yeah. As long as you catch it within 12 months, you can fix it. But if you missed it, there's one other strategy that's too deep for what we're talking about today. But don't make the wrong decision based on a headline. Or my Uncle Joe told me, I heard my barber, I was at the barber shop this weekend, and all these guys.
The Uncle Joe thing is really hilarious. Uncle Joe, says that we need to do this, that, or the other. It's like, okay. But you know what? When it comes to that, I think we're in a situation where we're going to see some changes for sure, but we've got to have no politician really wants to be the one to stand up there and go, I've killed Social Security.
Right.
So I don't think it's going anywhere. I
always said it's the hot potato, right? No one wants to touch it. Whoever touches it is going to be blamed for everything that's ever been wrong with it.
Yeah. Yeah.
But somebody at some point is going to have to fix it. And they will.
And
it's going to come to a point where they
may wait until the absolute dumpster fire is raging, but
right. So at some point it's going to get fixed but on the flip side, understand the pros. I mean, there's a lot of huge advantages of Social Security. It's guaranteed for life.
Yeah.
Has a cost of living adjustment. I mean, very few items do. Most pensions don't. And I mean, this year was 5.9% in 2022.
Which still cracks me up. It's like,
I mean, what's next? I mean, they're talking about 8, potentially, but look what inflation's been, and it goes a long way to help meet inflation. It's never going to equal inflation.
Right. Exactly. No, that's a great point. Well, let's finish off with number 10, Phil, and that's the whole DIY thing.
Sure.
We kind of finished off the first 5 with the difference with the fee-based and the brokers. To me, the DIY versus a lot of times the conversation goes, why pay somebody to do this? I can just do it myself. Right. The whole financial thing. Right. I've built this money myself. I don't need them for the other part of it. I don't need you, kind of thing. Right. Mm-hmm. And I would say there's some, just like a lot of rules of thumb, there's some validity there. Sure. And in the last 12 and a half, 13 years, the market's made it kind of easy to go DIY in, and you feel pretty good about yourself. And I'm a bit of a genius, but the distribution, Phil, and you just touched on some really interesting stuff in the weeds of mutual funds that most of us don't know. I imagine every single thing that could affect us as a retiree has some serious weeds in there that could be manipulated more if you knew what you were doing, which is why you would turn to a professional like yourself, in my opinion.
Right. Yeah. I mean, in today's day and age of the internet and YouTube and TikTok and all the other things out there. And I mean, there's a lot of information, right?
A lot of cool stuff.
For DIYers. I mean, it's great. I mean, if you don't know how to do something, look it up on YouTube and, fix this or that. I mean, there's a lot of great information, a lot of investment advice out there.
Sure. Yeah.
But again, if you're getting investment advice from YouTube, be careful, because what's the qualification of that individual? And do they really have any skin in the game, right? Do they have any, relationship and, an interest in your behalf, right? Are they looking out for your best interest? Probably not. And absolutely not, because they're not your client.
Yeah, exactly.
But there's a lot of moving parts, right? There's saving for retirement is relatively easy, right? I mean, number one, if it's a 401k, there's limited options. You don't have many options, right? Here's what I got. It's generally just saving as much as you can. When you get into distribution, the whole game changes, because now you've got Social Security options, you've got pension options, the whole tax side of the equation, looking at how the markets and volatility and sequence of returns affects money as I'm taking distributions. How do I structure that? If you're using the same investment strategy that you use to get to retirement versus now distributions in retirement, probably isn't going to work. May have worked if you retired back in 2012 and 13, and now you've ran it up, and that was your right. Early retirement. You're thinking, how hard is this? This is easy.
Look at the draw.
I'm spending. I've got more today than what I had when I started.
Yeah, I was thinking about that the other day. If you were lucky, my brother was joking too. He's like, man, I wish I would have been old enough to retire in 2012. He's like, I'd feel a lot better. He's 63. He's like, right now, if I retire the next year or so, I'm not retiring in a good time frame. I was like, possibly not. Yeah.
Well, yes and no. It depends. You're prepared, right? So when we're looking at clients, we're always looking long term, and we bucketize money. So markets do this. They have volatility. They're going to go through corrections. It's just what they do.
Phil, you have that experience, right? A DIYer might not, right? Again, they look at it and go, to your point, oh man, if I could have retired between 2012 and 2019, that's like the sweet spot,
Right.
You can't control that factor. Based on your age, I mean, if you retire when you're going to retire. So
that's right. It is what it is, unless you want to work another 10 years to, ride through whatever.
And maybe that's what the plan winds up having to be, but that's the point of finding out, because you just don't know. And again, it's all the nuance of the individual products, but then it's how they do this together, how they merge, and that's the disconnect for many DIYers, is because they don't really have the true, aspect of stepping back and have watched this for however many years, right? You've been doing this a long time, so you've seen a lot of stuff.
When I help clients retire every day, right? I mean, that's what I do. So I see it all the time. I can recognize, looking at a picture really quickly, this is some probabilities and problems you might have. Here's how we can fix some things and some strategies, right?
Some potential roadblocks.
You going into it, you don't know. I mean, this is what you got, and you're just running some simple ideas. You're looking up online and talking to friends and saying, oh yeah, this I think will work. But there's a lot of ways you can tweak this or that. And as you start changing one of those options, it changes the other. In my class, I've got this, I think it's an anagram, they call it. I always draw where there's the three circles, right? Income, assets, and taxes. And there's intersection of all three of them. As you change one, it's going to change the other, and it changes the other, and there's ways to manipulate and structure those that get the best strategy for everyone. So I always joke, it's kind of like a thumbprint. All of them look really similar. They've got the same components,
right?
But there's one that's unique for you.
Yeah.
So maybe for you, it's delaying Social Security till 70 makes the most sense, but maybe for your neighbor, it doesn't, based on their scenario. But you can't go to your neighbor and say, I filed it as soon as I could. Well, maybe that was right for them, but maybe, they've got health concerns and they don't think they're going to live long enough, but you are married and you got a surviving spouse you might have to be concerned with. So there's a different scenario you got to look at in your situation. You can't look at. I mean, it's very unique to everyone. So.
Yeah, I like that, because, I say a lot of times that, we have all these universal things that affect us all. We all have, fingerprints, but then when you start to really look at them, they get a little bit more unique. So that's a good way of looking at it. Kind of goes all the way back to the first one, paying off the house. Yes or no, right? I mean, it's fine for your neighbor, but it may not be fine for you, or whatever the case is. So it's all going to break down into that. So, the DIY approach, certainly nothing wrong with it, but I think many DIYers, at least a lot of the ones I talk to, when we get past 50 or definitely 55, we start going, there's maybe more of this than I realized. And then the other component is there's maybe more time involved in this than I want to spend on it.
Right.
Because I'd rather just be retired.
Yes, exactly. And that's the other side of it is in retirement, what do you want to be doing? Are you one that wants to be watching the accounts all the time? And, your spouse is probably not going to like that because you've probably been pretty grumpy this year because the market's been down. You're thinking, oh man, I don't know if we're going to be able to make it. I think I might have to go back and get a job,
And they've been waiting to spend time with each other. Or do you want to have a professional handle that, have a plan in place, can walk you through some of that, bounce some ideas off and say, look, we've been through this before. This is how it works. Yep.
This is how we're structured to handle it. So,
yeah, if you need to have the hands-on approach thing, go outside and work on the yard versus necessarily, versus
have some hobbies, do some, yeah. If you like investing, nothing wrong with that. Have an investment account, it's a smaller account. Don't take your retirement portfolio that's supposed to get you all the way through retirement and invest that. Because one wrong move and having things structured the wrong way, or even for your spouse, right? And I run into this all the time. Maybe one of the spouses is really into that. They love it. They're doing it. The other spouse is like, hey, I have nothing to do. I don't know what's going on.
Yeah.
So what happens when you die? What happens if you get hit by a truck tomorrow?
Yeah. Or you train wreck it, right?
Right. What?
Exactly. So, I mean, that's our top 10. It kind of all comes down to all of these things, do you need to necessarily pick a side? Is it one way or the other? There's a lot of, we joked earlier about an investment or a personality that talks, all annuities are bad or whatever the case is, but it's not really black and white, just picking a side. It's really more about how is it going to work for you and the uniqueness of your situation, the uniqueness, if I can get that word out. So it's all these little variables in there. So that's our top 10. Hopefully you dug that. You learned some useful information. As always, make sure you reach out to Phil or a qualified professional before you take any action. Again, Phil's a CPA and a personal financial specialist with many years of experience. So knows a little bit about what he's talking about. So you can find him online at philstaxhacks.com. That's philstaxhacks.com. You can reach out to him by phone or email or, go to the website. You can subscribe to us on Apple, Google, Spotify, YouTube, whatever you'd like. Certainly appreciate it. If you enjoy the message, share that with others who might benefit as well. All right. We'll catch you a little later here on Phil's Tax Hacks and other retirement facts.
Investment advisory services offered through AFS Wealth Management. The content of this program is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. Investments and/or investment strategies involve risk, including the possible loss of principal. There is no assurance that any investment strategy will achieve its objective.